Welcome to TheoTrade. This is Don Kaufman. It's February 7th, 2018. You are watching the Theo Night video. There's still about 25 minutes left in the trading day. A few points we're going to make on today's video. Number one, is volatility going to immediately subside? That is, some of the moves that we saw last Friday, Monday, was that just a little bit of kind of a flash in the pan? And is volatility just going to get crushed back down? Or are we going to live in a little bit more of a volatile market? Try to answer that for you. Number two is what I talk about, the interest rate tantrum. I mean, that's really what sparked all this volatility, is really the interest rates and ultimately the bonds. So we'll take a look at that. We're also going to look at a trade idea inside of the financials. Okay, why the financials? Well, it's a marketplace that I view right now as there's no way out. I'll explain what that means here momentarily. And last but not least, we're going to take a look at the XLU, which happens to be the utilities. Not necessarily a likely place, but okay, there could be some big opportunities in those utilities. Let's get started with answering a question just about volatility. And for that, I'm going to look at the S&P futures here on an intraday basis. One of the things that really stands out to me in terms of volatility, clearly I could go over and I could look at the VIX, and the VIX now it's retracted back to 23. But one of the things I want to bring you up to speed at is just some of the moves, again, some of the moves that we're seeing literally on an intraday basis. And well, what does that ultimately mean? Some of the moves we're seeing, there's candles here that, again, if you zoom in, it doesn't look like that much on the chart until you actually zoom in and realize, we're trading things like, and again, I'm going to just highlight it to show the depth of some of these moves. That's 2702 dropping to 2698. Okay, these are 1 minute candles in here. So we're still seeing some 4 and 5 point moves in incredibly tight periods of time out there. And that, again, kind of reeks of volatility. Now, in addition to it, and I'll zoom out for just a second. Okay, in addition to it, sure, when you look down at the VIX, and we're going to go a little bit longer duration on the VIX has actually compressed a little bit. However, there was a massive volatility event that occurred. I mean, literally, the XIV is gone. Any inverse, volatility products, for the most part, imploded. And that probably accentuated in many ways a lot of the push up inside of the VIX. We're still at about a 23 VIX. Okay, but that doesn't necessarily tell me if volatility is still imminent. So we're seeing, again, some wild swings in the S&P futures and the Nasdaq futures. Clearly, we're seeing big movement in the Russell. Okay, the VIX is still up at 23. But take a gander with me here at the VVIX. This is the volatility of the volatility index itself. And this one just screams risk to me. And until the VVIX comes in a little bit. And when I say comes in, I mean, listen, this VVIX has got to get down in this neighborhood of about 110 before I'm sleeping comfortably at night. You're still at a 150 reading. And for those of you, if you don't look at the VVIX on a day-to-day basis, what it is indicating to us is that the VIX options themselves, okay, are wildly volatile. In fact, if you do take a look at the VIX options, you cruise over to the right-hand side of my screen with me here, you'll see 130 vol, 160 vol. Okay, the volatilities are still off the charts, right? And again, that's indicative of there is still a tremendous amount of risk packed into this marketplace. Now, let's switch gears back for a second over to the S&P futures and explain one other aspect that I was looking at earlier today inside of trade. Now, some of you that are extremely experienced might be picking up on this. Most people are not going to pick up on this, but I am seeing some cracks in liquidity in the marketplace. When I say if you're experienced, you're probably seeing this, but even when I look at the S&P futures, and I'll explain a little bit more here, I'm going to go over to where it says active trader. Now, this is for people that are, scalping futures back and forth on an intraday basis. And I'm just going to freeze the screen for a second. And typically, when you look at the ask size, look at the bid size, the depth, okay, is usually in the thousands over here. We're lucky to see 300 contracts, all right, or 500 contracts in either side of this. I'm noticing that's just in the futures contracts, the depth of the market. These are bids and offers. And when it comes to the futures market, if you know anything about the futures market, that's a first in, first out marketplace. And what that basically means is these are real orders. All right? They're not supposed to be quote stuffing. They're not supposed to be canceling bids and offers out there. But there are very few professionals resting orders in the book right now. It's a little bit, again, intimidating to see that. In addition to it, we're looking at products like the spiders. Okay, everybody's pretty much familiar with the spiders, and you start opening up the options. And again, the options I'm looking at here just have literally minutes to go to expiration, right? These things are toast in about 18 minutes, as this is a Wednesday expiration, and it's Wednesday. But the bid offer spreads are 4, 6, even 10 or 20 cents wide at the cash open over here. Again, liquidity providers have seemingly stepped back, and this is an indication of a continuation of volatility in the marketplace until we see bid offer spreads collapse. I mean, you want to see 1 penny wide markets throughout the course of the day. You want to see liquidity return to the S&Ps. For the most part, we've been talking about algos for so many years, it's like people don't even remember how to trade in volatility. And that, people, is scary because we saw some sell-side activity the other day, and it felt like a bidless market. That means there were no buyers coming in. Number 2 that we wanted to talk about today is what I term as the interest rate tantrum. For the interest rate, I'm going to pull up the TNX. What does it stand for? Well, it's the interest rate associated with the 10-year Treasury. Take a look, because when you do, you're going to realize that what ultimately happened on Friday and Monday, guess what? We're right back up to that level. And we're starting to approach, again, the 3% level. If you believe that interest rates exploding higher is going to be a relative drag on the marketplace, you better be afraid. Now, this, again, has nothing to do with the volatility, let's say, but interest rates are once again approaching the highs. They're clipped just a bit lower than they were ultimately before retracting back on Monday. Now, you're not going to tell me that the marketplace is going to get used to a 2.8% or even a 3% on the 10-year, because the debt loads out there for how many companies are going to be absolutely massive. Again, you have to recognize what this does. This isn't just a trade, people. This is debt that is owed. And again, those interest rates exploding higher can have dire effects, especially on the junk bond market. If you haven't looked over at the junk bond market, take a look at HYG. Okay, this is a tradable product. Obviously dipping all the way down to 85.5 after, coming up, rebounding a little bit. But again, feeling some pressure once again, kind of late in today's trading session. All right, with that, and what I kind of call this interest rate tantrum, remember, the bonds are down big again today. Overnight, if these bonds continue to sell off, you may once again snap the back of the marketplace. To me, the bonds are sending a signal, okay, to everybody. I mean, they're doing their best to send off a smoke signal. And before I get into some of the specific trades, I just want to point this out. I want you to recognize that on Monday, while the marketplace was falling, and we'll just go over to the charts here for a second and point this out. And I'm going to bring up the 30. This is a 30-day 1 hour. So if you go back to Monday, literally where the market was absolutely tanking here, at the exact moment that the Dow was down well over 1,000 points, do you realize that they were swearing in Jerome Powell as the Fed chairperson? You have to recognize the irony of that. When I call it an interest rate tantrum, the markets, okay, are sending a message to the Fed. You raise rates, I'm going down. You raise rates, I can't handle it. And that's exactly what this marketplace is doing right now. And I'm telling you, and by the way, the futures here with 15 minutes to go are tanking right now. I'm telling you, it is far from over. Okay? The marketplace is trying to tell you something right now. What it's telling you, there is no room for interest rates going up. Okay? We're stuck in what appears to be somewhat of a liquidity trap. That will be discussed on future videos over here. The next thing I want to talk about has to be a trade associated with this, because it all comes down to like, hey, in the end, how do you translate this to a trade? First trade I'm going to show you happens to be here inside of the XLF. Okay? The XLF, everybody anticipates that higher interest rates are good for financials. Yeah, that's not necessarily true. Interest rates appreciating, albeit minimally, would be excellent for financials, and that's already happened. Interest rates exploding higher will snap the back of financials. I literally, last week, drew on the chart what was likely to happen in the financials, and it played out. Now, we've rebounded in the financials, but I'm telling you without an equivocation, this is the most dangerous product in the marketplace. Okay? I want you to think about why. Bear with me here. If the bonds rally back up, could the bonds rally back up? Of course they could. If the bonds rally back up, the financials will hate it. Why? Because they're going, interest rates are going lower. And if interest rates are going lower, they're going to kill the financials. Now, if the bonds continue on the trajectory they're on, which is hideous right now, to the downside, it'll snap the back of the financials and they're going to fall flat on their face. It's a trade that I call no way out. And I don't see a way out for those financials. How I am actually approaching this trade, okay, is to just use a deep in the money put. I'm just going to buy a deep in the money put. And you can see I'm already positioned, okay, and I'm in this trade right now. You can see the position in here. I'm just purchasing a deep in the money put right now, okay. I'm already, doing well on that trade. You could get away with using a 32 put. It's about a 90 delta. Work the bid offer spread. Okay, so that's trade number one. And again, I'm 120 days out. That's it. I'm just buying a deep in the money put. Why? The risk reward over there is going to be beautiful for this trade. I don't see an easy way out for financials. And it's going to be tough for somebody to say like, oh yeah, the financials are going to rally back up. Why are the financials going to rally up? Because the bonds are going to rally. If the bonds rally, they're going to kill the financials. If the bonds continue to sell off, they're going to kill the financials. It's a no way out kind of a trade. I think it's a really high probability that the financials are going to take some serious heat. Now, moving on. Last but definitely not least, XLU. This one's a really easy idea. The XLU is getting absolutely pummeled lately. And if you like a little bit of a yield play, okay, this thing is paying about 4% on the dividends. Now, XLU, could it sustain more downside risk? Without hesitation, of course it could. But it's looking pretty good out there right now. And again, you're looking at a little bit of a longer duration chart. I just opened up a 5-year daily, and I want to see, hey, listen, this thing it's come a long way. But I am starting to build an actual shares position in here. People talk about bottom fishing. Okay, I'm actually going out there, and what I'm doing is I'm selling puts. Okay, I'm selling puts. Why? The volatility in the XLU doesn't get to 23%. So I've been selling puts. Now, this is a put I actually sold yesterday. I sold these puts for about 44 cents. They've already crushed down to about, 10 to 14 cents. So it doesn't look like I'm going to be getting put stock there. I'm going to go to work and sell some more puts, probably around the 48. And again, start small, work your orders out there. This one looks and I want to clarify this. I am selling puts because I want to get put the XLU. All right. I want to get put the XLU and I want to start to acquire positions, and I will acquire this down into about the 44 level until ultimately I'm fully engulfed in the number of shares that I want to be long for this particular account. With that, again, we're seeing some pretty heavy volatility into the close here. As we said, that volatility, this is not going to subside overnight. This is not just a flash in the pan. There's a reason. There's a reason that VVIX is high, okay? There's a reason that the bonds are down almost another 2 full points over here. Expect in the latter portion of this week that you're still in the extreme. In fact, I'll leave you with this thought. In the next 2 days, you're expecting about a $57 move inside of the SPX. Again, a $57 move. Even with just minutes to go to the close, the SPX is still expecting almost a $7 move. it's going to be a wild and woolly couple of days over there. So look for the trade opportunities as they present themselves. Thanks everybody for joining us at TheoTrade. Have a wonderful evening.